For those who don't know me, my name is Paul Harding-Davis. I'm the CEO of Premium Asia Funds Management, and I will be somewhat of an MC today. Before we go any further, I do need to talk about the disclaimer. I realize for some of the financial advisors in the room, this normally gets skipped over, but we do have also some of our good clients here. Let me make clear that this presentation is prepared for general information only. It's not an offer to invest. It's not specific information. We're not taking into account anybody's needs, objectives, or personal circumstances. If you want more information or want to understand anything better, then can I recommend you talk to your financial advisor. Well, with that, let me get to the welcome and logistics. The first thing is, if you have your mobile phone, can you please put it on silent or make sure it's on silent or turned off. Emergency instructions, well, follow the staff of the establishment, but you can see a fire door there. There's a door there. The washrooms are out that door and along the hall, and then turn left past the lifts, and you'll find the washrooms there. Now, we are going to be using Slido. Many of you are familiar with it. You can use the QR code on the table. So if you look on the table, you'll see QR codes placed there. Feel free to use that, or you can go to this address. You will see it again a little bit later, but that enables you to ask some questions or participate in some polls, because you will get asked a couple of questions during the presentation. So today, there'll be a bit of an introduction. I'll say a few words. There'll be a business overview and from Jonathan, and talking about responsible investment and why premium. We'll have an Asian equities outlook with Renee, who's the portfolio manager for the Asia and China funds. There'll be a discussion about why Asian fixed income, and then an Asian fixed income outlook with Gordon Nip, who's the Chief Investment Officer for Fixed Income. Now, Renee and Gordon, clearly given some of the COVID restrictions still in Hong Kong, they could come here, but they'd have to take about a week before they could get back, go out of quarantine when they get back home, and I don't blame them for not wanting to do that. So they will be joining us by video at the ends of the room. So, for many of you in the room, just an important announcement. If you haven't seen it in our emails, we're very pleased to advise that all our funds are now open on BT Panorama, the administration service. We've been, as you would know, most of you, we've been working on that for quite some time. Equally, we're very pleased to announce that two of our funds, the Asia Fund and the Asian Income Fund, are now available on the Australian Unity Investment Bond platform. If you haven't looked at investment bonds, then talk to Australian Unity and talk to your financial advisor. They can be a very valuable product. So, most of you are here because you're looking for investment opportunities. So I just wanted to pass a few thoughts on about one way of finding them. And I stole this line, as you would know, from a famous movie. It was delivered by Cuba Gooding Jr. initially. And it's show me the money. It's always a smart strategy, we think, to follow the money. In fact, one of my favorite sports commentators says, if you want to know the answer to any question, follow the money. So the essential hypothesis here is that when incomes rise, retail spending rises, and business profits rise. It's not a revolutionary idea. But if we look at some of the major countries around and regions around the world, if you look here, on average, United States real total personal income grew at an annual rate of 3.32% from 1959, the year I was born, and yes, that makes me one of the oldest people in the room, but to 2020. And their retail sales, has been growing at about the same rate. $5.6 trillion US in 2020. If we look at India, one of the largest countries in Asia. You can see your change in personal income. The average is, if you go down to the bottom, you can see a 9.98% increase in retail income. Retail in India, 5.5% growth in 2020, predicted to be 1.750 billion US. Interestingly, it's still mainly food and grocery. In other words, there's an enormous amount of retail spending yet to move into the more consumer discretionary areas. China. Well, you can see this steady growth here in personal income. Retail revenue in China, about 1.97 trillion US dollars, growing rapidly. In fact, 14.2% growth in 2021, which frankly is a bit surprising given COVID. But China has a very strong penetration in e-commerce, in digital sales. So that will have underpinned that. And our nearest neighbor and our most populous neighbor, if not our nearest, but our most populous near neighbor, Indonesia, you can see a steady increase in GNI, gross national income per capita here, and retail sales average 7.41%. So you just get this consistent incomes rise, retail spending rises at pretty much the same rate. So if you sum that up, US retail sales growing at 3.5%. The most populous countries in the world are Asia, with enormous numbers of people still rising out of poverty and into the middle class. And the annual retail growth rates in Asia are about 250% greater than in the US. So I just posit that where are the greater opportunities likely to be? Now, I would also like to, before we get the formalities underway, just take this opportunity to acknowledge the traditional custodians of this land and the elders past and present. And he's not an elder yet, because he's still too young, but I'd like to ask you to welcome Jonathan Wu up to the stand now.
Thanks very much, Paul. Can everyone hear me? All good? Even at the back? Excellent. Okay. So thank you, everyone, for joining us today. I do have some good news to share as well with regards to next year. And as Paul said, yes, we couldn't get Renee or Gordon here in person this year, but we are currently finalizing plans for next March, and we'll be going around the country as well as New Zealand. Thank you for everyone also who's attending via live stream today. We have over 100 people there, so thank you very much to our friends across the country and in New Zealand as well. So what I want to talk to everyone today is spend about 15 minutes talking about the macro picture. Okay, I'm not a stock specialist, but I'm a macro strategist and looking after both clients' money as a financial advisor and also trying to educate the financial advice community for the last 20 years about the benefits of investing in Asia. And what I want to do is sort of separate fact versus fiction versus what we're seeing in the press, because there's been so much news about China and none of it has been positive over the last 2 years. Let's face it, there hasn't been a single piece of positive news about China. So to kick things off, I have a Slido poll. So for those of you that have smartphones, please vote on this question. Given low valuations in Chinese equity and fixed income markets, is now an attractive entry point to invest? I'll give it about 30 seconds. Just want to see what the room feels like today, given the economic news that we've seen, given the sentiment we're seeing in the market, because the sentiment is weak, and Renee and Gordon are going to talk about that. Sentiment does not equate to a bad investment opportunity, right? Sentiment is just driving down the valuation set that we've been seeing for the last 2 years, okay? And I'm going to ask the same question at the end. We have 90 minutes worth of content to cover off. I'm going to ask the same question at the end, and I don't know how this is going to end up, but so far the votes is just over half think yes, and so let's see if we can help change the minds of those that have said no thus far. So to give everyone the first macro picture, probably one of the biggest questions that I've received in the last 2 years is, we're seeing so much geopolitical tension. I'm talking to my clients and they're worried about what's happening in China and the US especially. I mean, where to from here? Are we seeing a crisis point or a flashpoint? So what I decided to do was take a slide or an image from Ray Dalio. For those of you who don't know, he is the founder of Bridgewater Associates, manages about $100 billion. This is from his latest book that was announced a couple of months ago. And what this is a summary of 500 years worth of history in a nutshell. What you see is that through the crossover path that you can see between the decline of the Netherlands as a superpower and the rise of the United Kingdom, followed by the decline of the United Kingdom, followed by the rise of the United States, there is a 20 to 30 year period where there is heightened levels of conflict. In each of these examples, the most common element or common characteristic of the declining empire is that they weaponize their currency to maintain their standing in the world. Today, we are currently at that next set of crossroads between a structurally declining United States and a rising China. And the US has spent many years weaponizing its currency to maintain its current position. This is very, very normal. It does not mean there is not investment opportunities. In fact, it actually brings up more investment opportunities for those that are investing for the long term. To give you an update on Value Partners, they're currently managing about $7.5 billion US between equities, fixed income, and alternatives. We have over 60 members in our investment team. And the key point here is that our investment team is based in the region. As you all know, that's what we pride ourselves on. We pride ourselves on two things. One, being on the ground. No other manager can even come close to our capability of doing company visits. And we're boutique in size. We don't want to manage a lot of money. We're simply not interested, right? We want to generate the alpha that we've delivered over the last, in Australia, 18 years, and in their broader funds, almost 30 years. And it's the same people running the money from 30 years ago. That is the amazing thing. You have an incredible continuity. Okay? Last year, we did over 6,500 company visits, and we did more than 6,500 company visits in the 10 years before that. That is our competitive advantage. It allows us to generate the best ideas where people can't invest, right? And during crisis times like now, where sentiment and valuations are so low, it means that we can do an even better job. On your desks, we've left one document that talks about have emerging market funds passed their use-by date. For those of you who are research consultants, I understand that the path of least resistance for you historically has been just to use an EM fund and say, that EM manager will have optionality for all the emerging markets. Now, on that front page of that chart, you will see that there is a lot of countries in emerging markets, but the ones that are relevant, there aren't that many. And in actual fact, when you go home and look at that paper, you can see that if you're not investing in Asia, the countries that are not Asia has been detractors to overall performance. It's quite simple. They have been detractors. And the thing is, if you follow an emerging markets manager strategy, then you also would give a US manager to invest in Australian equities for you, right? That's the same logical path. We do not do that, right? That's me taking a shot. But that's actually the reality, right? If your optionality, giving an emerging markets manager across every emerging market to invest for you, you would give a US manager investing for you for Australian equities. But we don't. Okay? So that's why we need to do our 6,500 company visits, which no one else can do. How do we then distill those ideas? We have a high conviction pool strategy. And the high conviction pool basically says each of our sector leaders and their analysts take the best of ideas into the individual sectors, and that sector leader has to choose 5 best ideas. It's a really simple approach. And those best of 5 ideas are presented to every single portfolio manager. So in the case of Renee, using a live example, Renee is the portfolio manager for the Premium China and Premium Asia funds, but she's also the sector leader for IT hardware as well as Taiwan. So she has to come with the best 5 ideas from her team in those individual areas, and then decide on how to implement those ideas into the underlying portfolio. Let's talk about ESG. ESG in Asia, I talked about a couple of years ago, was effectively an oxymoron, right? Everyone said, okay, Asia doesn't take ESG seriously. We have to consider the genesis of ESG. The genesis of ESG is from Europe. One of the biggest problems that we face with regards to dealing with ESG in Asia is that there's no carbon capture reporting. Right? There are global fund managers now that report carbon capture or carbon emissions trading on their portfolios and the impacts of that. We can't because there's no reporting data. So how do we take our ESG approach? We initially in 2019 signed up to the UNPRI, which is part and parcel of the process. Okay? We then subscribed to third-party analytical companies to do negative screening, right? That's the first stage, right, of ESG. Guess what? We found they were useless. Every major provider of data were giving us out-of-date data on issues for companies that happened 3 years ago. And when a PM puts in a trade, they get blocked by the middle office because it got flagged negatively. Then the PM has to write a dissertation explaining why the data is 3 years old, and it just slows down our ability to trade. So what do? We could stay status quo and just go, we use a third-party analytical company, good night, we're done. No, we decided to change the approach of ESG. Our approach to ESG is this simple. G is unwavering, right? G has always been part of our part and parcel. If there's no good G, which is the right people running the right company, then there's no returns to be made. But the E and the S, we measure from a risk perspective only. To be very clear, we are not an impact fund. We are not a green fund. We are identifying environmental and social issues that have or pose financial risks to companies. That is our approach. So we've built a 30-factor ESG proprietary model that we implement, and we have over 300 of those scorecards now built for our portfolio companies. So we didn't sit here and go, we'll take the cheap route. We built a proprietary model because no one else could provide us with a model that works in Asia. And we are now in the process of building carbon capture. Now, Frank, who's scheduled to be here in March, who you may have heard speak before, he's now the head of ESG investment for Value Partners, and we'll get him to cover more of that next year. As an example, this is our ESG report for the Premium Asia Fund. At 3.7, you can see from a normal distribution table that most of our companies sit between a score of 3 and 4.5. And we're more than happy to provide this information publicly for those that want it on a monthly basis. So, let's move on to fact versus fiction. I don't want anyone's hands to go up or down, but fundamentally I just want to ask a question. Do people think that China is no longer going to build property? Right? Because the property market is in crisis, people are boycotting their mortgages, they're refusing to pay their mortgages, government's coming up with a bailout plan, people are running on banks, or the regional banks are having runs, right? So China will stop naturally building property. I've taken this data from another Australian fund manager, right? Last 20 years, China has completed 11,000 million square meters of property. If we then divide that by 89 square meters, that is equivalent to 124 million apartments. Why is it 89, right? Did I just wake up and say I'll just use that as a figure? No. For those of you that don't understand the Chinese property market, 70% of all property in China that's built needs to be under 90 square meters in size. So we use that as a benchmark, okay? Assuming there are 3 people per household, one-child policy, there is about 370 million people that live in those 124 million apartments. Yeah? Simple arithmetic, nothing complex. The urban population of China in 2019 was 848 million people. So what I'm saying is the last 20 years of property that has been built is being lived in by less than half of the urban population. And so the question is, how is that possible? Well, a picture says 1,000 words. The people that are living in the properties that are built in the last 20 years are the ones living in the background. The ones that are living in, who are still urbanites, who are not living in new properties, is living in the foreground. That makes a lot of sense, right? That is what Chinese property is fundamentally about. There are still plenty of people that live in squalor. To give an anecdotal example, property that is older than 20 years, they share communal kitchens and communal bathrooms. That's what it's like in China, right? You may have visited China, and those of you that joined our China study tours years ago, you would have seen everything looks high tech. No, not always. This is what a lot of those cities in China look like. They are metropolises. So if we then statistically look at that same set of numbers I showed you, there is over 500, almost 500 million people that are living in properties in urban areas that are older than 20 years old. And the Chinese population is still only 61% urbanized versus South Korea at 81 and Japan at 92. If you think China is just going to, no, we're stopping building any property anymore, you are kidding yourself. It is not possible. Here's the second one. Has anyone read a report about China reopening? Has everyone read a report about China going into lockdown? No Australian newspaper reports that a city is reopening, right? They just report that it's going into lockdown. Okay? So the theory about lockdowns is that game over. There's no industrial production. Nothing happens. Last week, me and Simon, as advisors, we attended an AusBill, and I applaud. It is probably the first Australian I've met in 2 years that is so positive on China. An AusBill portfolio manager said, if you think China shut down, you are kidding yourself. Manufacturing did not shut down. Think about this. Last week, I'm a bit of a tech geek, Apple launched its new iPhones. Where are iPhones made? China. They launched it in September like they did last September. Did they not manufacture phones? Of course they did. How did they do it? Closed loop manufacturing. Has anyone heard of closed loop? Closed loop means that you work where you sleep. Therefore, COVID doesn't get in, right? Industrial production continues. Property development is a problem because you can't operate on a closed loop basis, right? Tradies have to go in and out. Here is IPP6 data independently sourced. This is coal consumption in China over the last 4 years, mapped across the major manufacturing cities. Courtesy of AusBill. On August 2, coal consumption was 10% higher than where it was last year, same time. You think China shut down? China did not shut down. Where is the weakness in China? Property development? Retail sales is weak, no doubt. We're going to cover that off later. But if you thought China stopped manufacturing, you're kidding yourself. For those of you who are taking photos, you don't need to because we will send these slides out in full high resolution to you after the presentation. So why us? Here's a couple of arguments. Again, this is data from SQM Research, right? That came out earlier this year. They did this as part of their standard table to look at the diversification metrics of our fund versus investing in Australia. Right? This is just taking the S&P ASX 300 total return index versus the Premium Asia Fund. The worst 10 months performance on the ASX 300 versus our performance. 7 of the 10, we outperformed the Australian market. Right? And by a pretty big margin. The 10 worst months in 12 years. I'm not cherry picking. This is the entire history of the fund, which is 12 years. Diversification. We're looking for correlation. We are now in a world that's gone from being globalized to being and retreating into protectionism again. The correlation of both our equity funds against other markets is low, right? MSCI World ex Australia versus the Premium China Fund is at a 0.2. And most other places, including Japan and Europe, is also down to 0.2. In correlation. There is diversification benefits in investing across Asia. This is our performance. It speaks for itself. This is the result of 6,500 company visits every year, right? 6,500, okay? And our largest competitor, which is the blue line. We don't make things complex. We don't do active currency trading. This is an unhedged fund. We're just looking out and trying to find the best stocks for your clients and delivering the returns that we always have. And we have plenty of capacity, which is fantastic. Drawdowns have happened before. This is that 12-year history of the Premium Asia Fund. Drawdowns have happened. First one, negative 27%, took 14 months to recover. Next one was down 16%, took 5 months to recover. COVID was down 9% and took 4 months to recover. I have no idea how long this is going to last. We have never received this many RFPs from consultants and financial advisors about investing in China, not even our Asia Equity Fund. They want to invest in China because it is now turned from being a TAA or tactical asset allocation decision to becoming a strategic asset allocation decision. Because you can't, the characteristics of investing purely in China is different to everywhere else in the world. There is no comparison. And the thing is, the macro environment in China versus the US is in complete 180-degree reversal. China does not have an inflation problem. China's risk-free lending rate is higher than everybody else and is decreasing. For those of you that are following it, on August the 26th, which is 2 weeks ago, China did cut both its 5-year and 1-year prime rate to stimulate on a monetary policy side. And it's now been set that October the 16th is the day of the NPC in China, which will pretty much 100% solidify President Xi Jinping's third term in office for the next 5 years, making him president for at least 15 years by the end of his third 5-year term. And we believe that there are stimulus measures that will come in after that point in time. One last thought I will leave with you before I pass over to Renee. One of the biggest concerns that other people have also mentioned to me over my 20-year career here as to why they're not investing in China is because they're so worried about the volatility of the underlying market. It's driven by retail mums and dads, they're traders, completely agree. That creates the volatility, especially in the A-share market, otherwise known as the mainland Chinese market. That's going to change. Why? China just announced they are launching the third pillar of their retirement system, pension system, right? Where do most of our Australian super money get invested in? Australian shares, right? We have a home bias. Here's the shocking potential. This is 2022 data, total pension assets as a percentage of GDP. Australia is 130%. So our super system is 30% larger than our economy. You know how we all talk about this huge runway of growth we have in the Australian superannuation system because we have SGC? Look at China. They are running a co-contribution system now. This contribution system is going to be huge. Not only that, let me double it down for you. Who has the largest savings rate in the world? China. Savings rates matched with a underpenetrated, it's almost non-existent pension system. They already launched pillars 1 and 2. This is the third pillar. This is the structural tailwind of Chinese equities going into the future. They're already the world's second largest equities market by a long shot. So with that, I hope that gave you a good macro scene to start off with. And hopefully the technology is now going to work. I'm going to hand over to Renee Hung. Renee is the portfolio manager for the Premium Asia and Premium China funds. She's been with Value Partners for almost a quarter of a century. Right? That is a long time to be in one place, but she knows the markets inside and out, and she's going to give you an idea of how portfolios place and also the themes that are running through our portfolio. So, Renee, over to you.
Thank you, Jonathan. I'm Renee Hong, Senior Investment Director at Value Partners. It is my pleasure today to present to you our latest views in the market in Asia ex-Japan and China. So while I'm not going to repeat the key concerns going on in the global markets, we see that some parts of Asia, including China, should fare better than the rest of the world during these challenging times. China's CPI numbers has been quite contained. China's inflation is at 2.7% in July 2022 versus US 8.5%, Europe 9.1%, so this is one thing less to worry about. At the same time, China is in a very different stage in terms of policy rate cycle. As you can see from the lower right-hand table, China has kept rates fairly steady since 2017. Therefore, in case required, there are still room for further easing. However, we are seeing challenges in various areas in Asia as well. In China, due to its zero COVID policy, we are still seeing lockdowns in different regions now and then. As Jonathan mentioned, these lockdowns do not mean stop in production. Though these lockdowns, China's economy did suffer some impact because there are lots of other business activities. At the same time, countries in Asia, which are more export-related, such as Korea and Taiwan, they are seeing weakening global demands. The declining demand is exaggerated, especially after a very strong demand upcycle due to the work-from-home effect in 2020 and first half of 2021. For example, notebook demand has declined 20% year-on-year in second quarter 2022. But this is after rising more than 50% in the end of 2020 and early 2021. Despite recent developments, we expect better performances in the run-up to the 20th China's National People's Congress in November and onwards. Started since end of 2021, Chinese government has launched a series of fiscal and regulatory easing. However, these policies fail to be too effective because of the resurgence of COVID cases in China. Nevertheless, we are expecting a more healthy earnings momentum to resume into 2023, given the low base and continuous easing policies from China. In terms of properties, which is being one of the most concerned sectors, first of all, we need to recognize that properties will no longer be an important pillar for the economic growth going forward. Housing is for living, but not for speculation, the government leader said. Chinese government is determined to prevent a huge problem for them to deal with in the future. Of course, currently there are still difficulties to overcome. However, the government has been proactive in launching measures and support has been extended to meet people's basic housing needs and the need for improved housing conditions. For instance, some cities have begun to relax mortgage loans recently for the first and second home buyers. If housing sales remain weak in the next 2 months, mortgage rates have further mild room to decrease. It is possible that the property market has seen the worst period and will slowly recover. Anyhow, China will maintain easing liquidity and credit policy to stabilize the property market. Korea and Taiwan markets are the region's worst performers year to date, each down around 30%, as they are the region's most sensitive to global demands. After a very strong semiconductor and tech cycle in the past 2 years, driven by work-from-home demand and supply chain constraints, we are seeing a reversal back to the mean in terms of demand of electronic products. The cross-trade geopolitical issues between China and Taiwan added some strain to the situation. However, not only we are seeing local governments are launching supportive measures, We are now also expecting that we are in 2/3 of the inventory correction cycle. So at the end of the day, we do expect that there will be two key supply chains for electronic products globally, one in China and one in the rest of the world, of which Korea and Taiwan will be the key players. We are seeing mixed performances in ASEAN year to date. While the whole ASEAN still outperformed the MSCI Asia ex-Japan region. In particular, we prefer Indonesia and Singapore, while we underweight the rest of ASEAN. This table is as of about a few weeks ago. The latest situation is that we have seen Indonesia and Singapore actually outperforming the whole ASEAN market. For Indonesia, we like it because it's strong macro backdrop. It has been enjoying robust export performance on strong commodity prices and increase in volumes of nickel-related exports. It also has strong GDP growth, current account surplus, and the currency has held up reasonably well. For Singapore, its central bank has been aggressive on policies. So year to date, Singapore and Indonesia are the two best performing currencies in ASEAN. Singapore economy will not be spared by global slowdown, but at least it will be in good health. And by itself, Singapore market is perceived to be a defensive market, so should somewhat outperform during this period of volatility. Philippines and Thailand, we expect that these two countries continue to be weak because they are quite hurt by inflation, being a net importer of oil. Thai market's tourism story is still suffering, especially with China's lockdown. Chinese tourists haven't come back, but then gradually it will improve in momentum, even though we are still quite a bit far away from it. Despite global market uncertainties, MSCI India Index posted a single-digit fall of about 5% over the past 6 months year to date, again outperforming the MSCI Asia ex-Japan Index. But apart from the recent positive global market cues, the strong outperformance is likely driven by non-fundamental matters such as foreign equity inflows, robust domestic flows, and easing of commodity prices a bit. Despite the global uncertainties, we have fairly positive, optimistic outlook for the MSCI India, but the valuations again are quite expensive. For reference, the price-earning ratio for the market is at 22 times, which is 1.5 times of the 10-year average, or a record premium of 70% to the region's price-earnings ratio. While the structural story remains intact in India, we continue to monitor how high interest rates, continuing in high inflation, oil prices, and global economic slowdown may affect the country's economy in the medium term. The last two slides is a summary of the regional market performances. And we would like to argue that MSCI Asia ex-Japan and MSCI China have started the correction way before the US. As you can see from this table, MSCI Asia ex-Japan declined from the peak in last March by 35%. And MSCI China declined 50% from last March peak, whereas US just started correcting 15% from peak in early January 2022. Regional valuations have also come down aggressively, from peak of about 18 times to about 12 to 13 times for MSCI Asia ex-Japan, and even slightly lower for China. So we believe that current time, a lot of bad news have been priced in, and then we also encourage investors to look at the markets in this part of the world as a diversity. So to go into a little bit more on the investment themes into Asia and China, we have highlighted 4 key investment themes that we have discovered some companies for the portfolios that we are running under the premium brand. The first one is Asian technology leaders. So as I mentioned a bit previously, inventory has continuously built up since second half of last year after a very strong semiconductor cycle and also electronic products inventory building cycle in the past 2 years. So we are in the midst of inventory correction. And generally speaking, we are expecting that the inventory correction should end by first half next year. And as you know, investors in the stock market usually look forward. So a lot of the investors or even sell-side brokers are trying to look for entry points now in the technology segments. From our point of view, we think that there are segments within the technology still have promising long-term growth. Of course, I'm not talking about PC or smartphone. These 2 segments we are expecting when everything back to normal, maybe plus or minus single-digit decline or growth in the years to come. However, we are seeing that demand for like data center related, high computing power PC, electronic vehicles, and even industrial automation are going to have long-term drivers within their own segments. So we are identifying companies that can benefit from these segments and then trying to accumulate shares and a position to enjoy for the future growth. In this presentation, I have highlighted one stock which maybe is not too, is maybe quite familiar to all of you, TSMC, which is a leading foundry player listed in Taiwan. Basically, maybe some of you already quite familiar is that this company has 50% global market share in semiconductor foundry businesses. In the next 5 years, we are also very confident that they are going to retain the leadership position in the advanced node for foundry businesses compared to its competitors. Of course, you may also hear news that they are going to open factories in US, Japan, and even Europe over time. So as I've mentioned briefly, we are seeing that due to the US and China relationship, electronic or technology segment is one of the most impacted segment. We would expect that going forward, China will have its own supply chain to support its internal requirements in terms of all sorts of electronic products, whereas the rest of the world will be dominated by very high, very well managed companies like TSMC. That's why they were also required to open the foundry to become a very key local supplier within the States and other parts of the world. So of course, there may be some here and there, some short-term noises in some of the electronic product segments. But generally speaking, we believe that TSMC compared to its peer have a lot of pricing power and a very strong cost control advantage that would be beneficial to the investors going forward. The next important theme, I think, in the region still remain to be in the consumption recovery theme. Consumption is not only important in China, but also regionally within Asia. Of course, we believe nowadays because China is suffering from the zero COVID policy, so that's why a lot of consumption names in China are quite depressed. Whereas some of the regional consumption names have slightly recovered. So that's why for the moment, we are having a skew towards these Chinese consumption recovery names in the top holdings for the portfolios. For example, we are holding again back, which is one of our favorite stock for the longest time, Guizhou Maotai, which is the top leading Chinese white liquor brand. We used to have a lower weighting in the past a few years, but recently it's back to the top holdings. And then Zhou Dai Fok, maybe for some of you are also quite familiar with it. It is a jewelry brand, one of the leading jewelry brand in Hong Kong and China. We have seen in the recent results that despite the COVID lockdowns in China, they are still able to deliver good earnings growth in the China market. So we believe the management is very well positioned compared to the peers to benefit in case when China reopens. Not to mention some of the local sportswear brands. Of course, Nike, Adidas, Lululemon has the market in China. But usually these brands are confined to the first-tier cities in China. We have seen that a lot of Chinese local brands, after 15, 20 years of cultivation in China, have gaining traction and become the market leader, overtaking these kind of overseas brands in even the first-tier cities in China. So we believe that currently is a time for us to also hold on or add to the position to benefit for the future recovery in China consumption names. The next segment would be internet companies. So internet companies, I remember we spent quite some time to talk about it in the last year's webinar because it was suffering from quite a number of policies announcements in China in 2021. But actually, after all these policies, updates, and readjustment in terms of management strategies, we are seeing the internet companies are moving back on the right track. For example, some of our leading companies in the portfolios, Meituan, Tencent, or even Alibaba, we are also seeing more clarity in terms of the medium-term growth potential. For Tencent and Alibaba, we are seeing that cost control and expenses control are the key future strategies. And then also, especially in terms of internet gaming for Tencent, we are seeing some reapproval process becoming more active in China for all these online games. So we believe the environment for like Tencent or e-commerce related businesses are going to be more stabilized. Meituan, we believe that after all the COVID challenges and the policies announcements in China, it has evolved to become a premium leader in terms of management strength and also the online delivery products and services quality. And then we are seeing that they are focusing on improving the profitability because of their leadership position. And we are also very happy about the recent results. And as a result, we maintain them as one of the core holdings on the portfolios. Last but not the least, in terms of the investment theme, we like very much the rising wealth management businesses in China. Basically, in China, as a lot of you might know, it's a very underdeveloped market in terms of the financial market. And a lot of people are a lot of the population like to hold on to property as their core assets. As you can see from this graph, it's a survey done by CLSA recently. As at 2021, property as a percentage of Chinese total household asset allocation remains to be the highest at 37%. But this has come a long way from being 50% more than 15 years ago. So basically, judging from our study or maybe a lot of survey in the US, Japan, or other developed markets, this number is set to continue to decline. And according to the CLSA report, which we also agree completely, is that property as a percentage of household asset allocation will continue decline. And at the same time, Chinese government is eager to develop the financial market as another source for asset allocation for Chinese household. We have seen that a lot of the Chinese investors or Chinese population are shifting the asset allocation from property to financial products such as like mutual fund, or maybe at the beginning, a lot of them switched to the stock market. But because of the market volatility, they are being more educated and preferred sophisticated or maybe professional investors to manage their funds rather than they go into the market themselves. So we believe that some of the stock examples, for example, China Merchant Bank, East Money Information, they are all names that we think that will benefit from this trend because they are the leading player established already for the past 20 years in China. And basically, we are tracking the market share momentum, and they are performing very healthily despite the challenges in the market. So these are the 4 key investment segment or pillars for the portfolio. So allow me to move forward to talk about the fund performances and some of the key highlights. In the first part, I'm going to talk about the Premium Asia Fund. So here you can see that the long-term track record remains solid, despite that, again, short-term, we are hurting. But we are still making sure that are we holding on the best names that we can find in the market. And later, when you look at the top holdings, I would like to also give you more confidence in that. But in terms of geographical exposure, as you can see from this slide, we are maintaining about low single-digit cash level. The 6% is a little bit on the high side because due to just buy-sell, transactions. And Premium China Fund will remain to be about low single-digit going forward, because we do see the market valuation has discounted a lot of the bad news, and we are positioning for a recovery. In terms of geographical exposure, some key points to highlight is that we are still quite bullish on the China segment. So as you can see, A shares, in particular within the Hong Kong China space, we have about quite some weighting there, about 12%. We believe that on the short term, of course, there might be market influences or noises from overseas market. But China Asia remains to be more resilient given the foreign forex control and the fund flow control. And then as we move towards the 20th National Congress meeting, more clarity in terms of the leadership would also help stabilize the market. Korea and Taiwan, we are also watching for a potential timing to increase more weighting, given what I mentioned in terms of the inventory correction. ASEAN, we will try to maintain more or less a similar weighting. The next slide highlights the top 10. I won't go through too much on the details, but as you can see, the top 10 names, for example, TSMC, Samsung Electronics, actually would be related to the Asian technology leaders theme that we mentioned previously. Guizhou Maotai, Meituan, Zhou Daifeng, or East Money are also related to the respective investment thesis. China Mobile is actually a parking cash for the portfolio. But it's not only a pure defensive play, because we are seeing data, businesses in China is increasing demand. And then also the company is willing to pay very strong cash dividend yield. So we believe that it has a very solid position in both the portfolios. One thing to highlight is that all our portfolios have fairly high active weight because we believe in bottom-up stock picking and rely on our investment team to find the best stocks. The last part here is the premium China fund performance. Again, we have a fairly decent long-term track record, despite the short-term has been challenging. Going to the geographical exposure, as I explained, Asian market compared to the Hong Kong, China, will continue to be more resilient. So again, for this portfolio, we are having a slightly higher Asia exposure. Top 10 weighting for the portfolio. Also, there are some familiar names that you can see from the Premium Asia Fund. But again, we don't want to deviate too much from the four key investment themes that we mentioned previously. So here ends my part of the presentation. And I would like to pass on, and we will have a Q&A, and we can talk more about the Asia ex-Japan and China equities. Thank you.
Thanks very much, Renee. So switching gear now, we're going to move on to fixed income, an area that, for those of you that are invested in the strategy, thank you for your patience with it. We fully understand it has been a very challenging time in terms of returns. We haven't wavered from our investment thesis nor the philosophy. You have seen the distributions continue to pay out at 1.5% per quarter. There hasn't been any issues with regards to that. These are all mark-to-market movements, right? In terms of being incredibly aggressive, Gordon's going to go through that shortly. But I want to sort of recap quickly what we do in fixed income. We're still using a relative value approach, okay? So we're trying to find cheap credit, right? Credits out there. These are all listed credits. They're all 97% or so is USD denominated, right? We like USD because there's a higher level of liquidity. It is a harder job for a domestic Chinese or Asian company to list US dollar credit as opposed to local currency credit. There are other strategies out there in Australia, but they are not comparable to us. I'm not talking about performance-wise, but when you are looking at emerging market debt as a concept, please make sure you look carefully at what they invest in, because it's not a better of us is better than them. There are funds that play on pure government bonds in emerging markets. There are ones that invest in emerging market debt, but in local currency. So that's a different investment thesis to us. We are investing in corporate debt, a majority of the time, in US dollars. So we buy primary issuance. Most of it is secondary issuance, obviously, on the second market listed. We have had a record level of investment grade debt in our portfolio because we've been more defensively positioned at this point in the market. People have made comments to us previously that said that we are a Chinese property debt fund. No, we are not, right? The amount that we have in property now is about a quarter of the portfolio, as opposed to a historical high that used to be 70%. This goes back to the point I was making. It's about being active, right? It's about being active in the market to ensure that even through this most challenging time, we get you the 6%. Kellogg's packet, we said in 2010 when we launched this fund, we want to give your investors 6% distribution a year, paid quarterly. We have not failed to do that, to be very, very clear, no matter what the market conditions are, including this period, which is the most challenging period that we've had. Okay. There's also, remember that there's 6 to 7% of our portfolio that's dedicated to what we call special situations. And special situations are those idiosyncratic trades that we make where the market's completely priced a piece of debt wrongly. So Gordon's always said, and this is the one line I always remember for Gordon, there is no such thing as a crap piece of debt. There's only a crap price you pay for a piece of debt, good or bad, right? And so something that's as distressed as now is a great opportunity for those that are participating in this market, okay? Again, I'm going to show you a statistic. This is just fact. I'm not sharing any opinion. Through the history of the fund, these are the three widest bands we have seen between the cash yield and the yield to maturity. The cash yield is the yield of the fund based against the fact that all the debt in our portfolio is priced at $100, which it clearly is not, right? So these debt that become mature, you get back your $100 if they didn't default, right? That's the whole strategy of this fund, which is why you're picking stuff up at a very, very discounted rate. In 2012, the cash yield was 8.3% and the yield to maturity was 15.9. What does that 15.9 mean? That 15.9 reflects that if all the debt that we hold at that point in time matures and pays back at $100, you will make 15.9% per annum. November 2018 and then March 2020, which was that COVID hit. Every single fixed income fund, investment grade, high yield, opportunistic credit, all fell through the floor. But it created that opportunity. The difference, ironically enough, in the first three worst periods was always 7.6%. I did not pick it. I did not make this up. This is literally what the statistics show. The widest ever point. And this time, the point is 17.5%. Right? Over 200% as wide. That's how the market is pricing in the confidence of the Asian credit market. It's priced for decimation, because for those of you that look at the bond markets, anything that's trading under sort of $90, 90 cents in the dollar, is in crisis mode. During the European debt crisis, the lowest point that Greek sovereign debt got to was $30. Right? 30 cents to the dollar. And that was how bad the Greek situation was. So I'm not trying to predict the future. I'm telling the hard fact today is that the spread between the cash and the yield to maturity is more than double than what it was at any previous crisis point or flash points we've seen. And we're completely active. This fund's also not correlated to anything else in your portfolio. I can guarantee you that, because it doesn't act like anything else in your portfolio. But it gives you that 6% consistent yield that we've paid in the last 12 years. And yes, our family's $7 million investment is now worth $5 million. But we are invested alongside you. This is very, very important, right? All our families, our family wealth is invested heavily into our own strategies. With that, I want to pass on to Gordon. Gordon is the CIO for fixed income. I don't think Gordon has spoken here in Australia, but again, we have booked him for March. Gordon has been with Value Partners since 2009, firstly as a fund manager, becoming senior fund manager, and becoming the chief investment officer. And I'm going to hand it over to Gordon to talk to you about how our strategy is currently placed. Thank you, Gordon.
Hi, thank you, Jonathan. Thank you very much for having me this morning, my time, maybe afternoon, your time. So as you mentioned, this is my first time doing this, so I'm very happy to be here. So I guess previously you have heard Renee talking about the Asian stock market. So my session is all about credits in Asia. I'm sure a lot of you guys have a lot of questions about Asia, in particular the state of the China market, and in particular the Chinese credit market. So let me just fast forward. Okay. So obviously, without speaking, the Asian market has been having a very, very tough time right now, and as you can see, if you look across all the asset class, whether it's stocks, bonds, or even other alternative investment, it's very common to see a year-to-date return in the sort of negative double digits, sometimes more. As far as Asia and in particular in China is concerned, I think our market has been sort of double hit by a couple of factors. First of all, obviously, is what happens globally. For example, the Federal Reserve interest rate hike cycle has started, and arguably has become very, very aggressive recently. We are talking about the Fed fund rate could be well over 4%, and by the end of the year, also. And obviously, and because of the geopolitical environment, namely the war in Ukraine, and also the sort of conflict, trade conflict or conflict in other areas between China and US. So all these happening globally has had a very, very bad impact on the Asian market, whether stock and bonds. Internally in China, China also has its own set of policy that are, to be very honest, not very conducive to the health of the economy. Mainly is the zero COVID policy. So, so fast forward to today, it's really, as I mentioned, it's really, really easy to see anything that are down for anywhere. For, as you can see from the lower left-hand chart, even for the sort of quote-unquote safest investment grade bond in Asia, year to date, we are talking about down 8%. I attributed most of this performance was mainly due to durations and curve. And then if you trend down to lower credit quality, if you look at Asian high yield as a whole, talking about down almost 30%, and in particular, the focus of all the credit market is the real China real estate, the China high yield credit. As you can see, is down more than 40%. Okay, so the market has been really, really difficult. And as you can see on the top right, you can see the home sales so far this year in 2022 has been consistently trending below trend compared to the last few years. Obviously, given that kind of performance, spread has definitely widened versus the Treasury counterpart. So that's one thing. Now, if you talk about Asian credit, you have to talk about China. As I mentioned many, many times, that if an investor wants to invest in Asia, they have to look at China, because China accounts for more than 50% of the universe. And within Chinese credit, whether you like it or not, to some extent, you have to look at the property credit. So unfortunately, the problem right now is really on the Chinese property credit right now. As you have heard from all the news media, one of the most notorious developers called Evergrande. And starting from Evergrande, we have seen many developers has fallen, name by name, over time. And that's basically because of the restrictive measure on the government, that they really want to try to cramp down on systemic leverage employed by this company. They want to bring down the leverage so that the sector will be able to survive in a more consistent manner going forward. And also, because of the strengthening requirement, some of this developer has experienced some delay or failure of home delivery, meaning home buyers put their hard-earned money into down payment. Some of these buyers may not be able to get their flat or house they were promised to. So therefore, it resulted in some sort of noise in the mortgage down payment. But right now, it's very clear that government would not want to see a massive incidence of mortgage non-payment. And being the Chinese government, the last thing they want to see is to see thousands of people gathering in front of City Hall and protest, because this will have a direct detrimental impact to the governing of the country. So therefore, the government has been trying really hard to contain the mortgage payment, and they actually have pledged money to on project delivery. Okay, so if you drill down into the mortgage boycott, mortgage crisis, you can see some of these failed projects really concentrated in just a number of names, notably Evergrande, as you can see the lower left chart, right? Also some of the names as well, but by and large, a lot of these non-delivery home was basically coming from the developer having the most problem, okay? So I think systemically, and especially if you look at the right side, the table, as you can see, the bad loan, so-called the loan grant to real estate among the big Chinese commercial bank, it has only accounted for really small percentage in terms of their total loan size. So therefore, we believe that even though there are pockets of mortgage boycott, actually some of them may not have resolved yet, but on a systemic level, we do not believe this boycott will have any really big major impact onto in terms of posing systemic risk to the entire Chinese market. I think the main thing to take away from this slide is basically after all said and done, I think the property sector will be predominantly or majoritively consists of developer with a state-owned background, so-called the SOE advanced POE, which is the private owned enterprise regime. So you will see proportionally more state-owned name in the property space going forward after all said and done. So obviously, after all these, the confidence has been quite low, okay, and a lot of these companies will face a varying degree of refinancing pressure. So as you can see, the next measure is probably coming in January 2023, where you have a substantial amount of coupon and principal that comes due. But if you look at the space right now, which I can show you later on, is that if you look at all the property bonds right now, a lot of them, they are trading anywhere from low single digit to in teens. Some trade in 30, 40, some trade in 50, 60. So I think I would say that right now the market, in terms of market action, likely has bottomed. Now, I'm not saying may not be more downside. There may be some more downside or even some more negative coming out as well. But in terms of the market pricing, personally, speaking, it's just my own feeling is that I think the downside has already, or greatly priced in the market right now. Okay, so that's bad enough. The first 3 pages that I have already spoken tell you the situation and also the situation is. So next few slides, I'm going to show you some more happy news, which is some green shoots. As I mentioned, the market right now has substantially priced in any downside scenario in the property sector. Okay, so right now I would say we're at the juncture where the upside and downside may not be very balanced, meaning looking forward, there may be more upside than downside in the next 6 months or so. Although I would say, to be very honest with you, the recovery may be slower. Okay, so we are talking about the sector will recover, but I do not believe there will be a V-shaped recovery. It's more like a U with a relatively long base. Okay, so just to show you some evidence, so in terms of the contract sales, the property contract sales on the upper left, the red line is the 2022 trailing contract sales. So although month over month it has been trending below trend compared to the last few years, but recently we have seen some stabilization on contract sale, and in some months the contract sale has marginally up as well. Year over year, still down, but at least it seems to us that it has stabilized on the downside. Now, on the loan rate, the lower left-hand side, Everybody knows that the Chinese PBOC, they have recently cut the loan prime rate, the LPR. In particular, they have lowered the 5-year rate much more than the 1 year. Now, the 5-year rate is one rate that are basically benchmarked to mortgage rate. So this is one evidence showing that the PBOC or the Chinese government, they really want to help to improve the home delivery in Chinese property market. Although, as I say, although the Chinese government would like to help this sector, I need to stress to you, I got to be very honest with you that any money that developer receive, this money will likely to be direct towards completing unfinished home, so that home buyer will be able to have their flat delivered. It is very unlikely that this money will be channeled to the credit market for companies to repay their upcoming loans or bonds. Okay, so therefore, the improving credit profile to me will be sort of indirect in the sense that company needs to see their improved contract sales, and whereby through their earnings, their debt servicing or principal repaying ability will be able to show on paper. So therefore, as a credit investor, we are happy that the underlying market has slightly bottomed, but we also really cautious about the well-being, especially in the next 6 months. The developer in this space, they are still subject to very, very stringent liquidity conditions. As far as the COVID situation is concerned, you can see, obviously China right now is kind of stand as its own part, a part of the world where the rest of the world has already opened out and seems, you guys have, go back to living the daily life normally. But, in China, in Hong Kong, we are still, in particular China, they are still practicing really, really stringent COVID-0 requirement. But one thing to be more optimistic about is the vaccination rate in China has consistently been going up, and I think after the Party Congress, which is the next month, October 16, the market is looking for more relaxation in supportive measure for the government. And by and large, I think in terms of the society activity, as you can see, the flight, in terms of flight. Although Chinese people inside China, they may not travel freely internationally, but internally within China, domestic flight has been picking up. So that's one side that they are resuming some sort of economic activities that will be able to bolster the economy a little bit. And also the cement shipment as well as the migration index are published by Baidu that although we are not at the height, but at least give you the same picture that the bottom has already way behind us right now, although the recovery will be quite slowly. Food prices, inflation. Inflation in China is actually impacted by, most importantly, food prices. Chinese people, they eat a lot of pork, and pork prices has been going through the roof. So that's one factor that will drive inflation higher. But on the other hand, a collapse in housing sector, I would say collapse, it's just a lower housing prices will help to dampen any inflation expectation. And also the COVID-0 lockdown has really, really hampered our retail sale and consumption. So by and large, we think that there will be some inflation in China, but I think the top line inflation, it should not be as high as the developed market in our view. And therefore, we think that even though the RMB will depreciate a bit, but I think it won't be depreciating a lot at the current level. So I think together, I think the China obviously is going through some difficulty right now. But however, if you look at the rest of the Asian economy, they're doing pretty well, right? For example, in India, in Indonesia, these two countries, which is represented by the next two largest credit market in Asia, they are doing quite well. Right? The GDP is doing quite well, and also the inflation hasn't been very high. and they are arguably net debt as a country for India and Indonesia. So therefore, we have been selling down some of the property position, and we allocate some of our capital into India and Indonesia as well. So overall, I think this market has also been sort of fallen in sympathy with the Chinese market, because when a lot of people say when China's started to have some sneeze, the rest of the Asian country will have some cough as well. So all the Asian country credit has also fallen in sympathy with the situation in China, same as Macau as well. So I think altogether, I think the Asia credit markets actually they are actually quite cheap. So in terms of absolute yield, in particular China high yield, we are talking about in excess of 20% yield to worst. Asian high yield as a whole, we are still talking about in the teen, right? Asian IG low single digit. All these compare quite favorably with other emerging market or even US market at this stage. The key for investor right now is not to know how cheap the Asian credit market is. The key for them to know is to what kind of risk they are taking right now. Okay, to me, the bigger risk is not knowing the risk. The biggest risk is not about taking risk. The biggest risk is not knowing what risk you are taking. Okay, so at the current structure, we believe first of all, valuation obviously very attractive. Okay, now fundamentally speaking, we think that especially on the China property market, we think the market on the policy wise has at least bottomed. Market confidence, honestly speaking, are still relatively weak because investors mostly like to see things happen before they would deploy the money. But nonetheless, a lot of investors, I can tell you that I have meetings with investors in US and Europe, and many of them, they are actually looking at this market because simply it's too cheap it is. However, they are still not very clear in terms of where the macro will go, whether it's interest rate front, whether on the war in Ukraine, or even domestically the Chinese policy on zero COVID. So there are a lot of things for them to consider, but nonetheless, needless to say, this market is cheapest of the cheap right now. Okay. But however, if you take out China, the rest of Asia, the fundamental is actually pretty good. I mean, if you look at, for example, Indonesia or India, their currency hasn't depreciated much against the US dollar. If you compare, globally, all the country currency, right? And also domestically, the Asian country today, we are not talking about the same Asian country back in 1997, right? Where most of the country were still relatively small in scale and highly susceptible to risk globally. Today's Asian nation, they are much stronger, both domestically and also in terms of their reserve. So they have much more room to buffer any macro risk in our view. Now, this is another way to show you how cheap this market is. Everybody, they study Statistics 101, and we remember, the likelihood of one standard deviation event, right? Plus or minus one standard deviation, that covers around 66% of the probability. So we are talking about at this stage, 2 to 2.5% standard deviation event for the past 5 years. Okay. So especially for China, although we are right now not at the cheapest point, but 2 standard deviation event actually is quite rare, from our view. So that's another way to look at how cheap this market is. So lastly, I'm going to talk about a little bit the performance of the fund. As you can see, before this great tapering and the COVID crisis, this one has been posting almost a straight line performance since inception, which is pretty good. Unfortunately, that trend has broken. Okay. On a year-to-date, as of the end of August, the fund was down about 16%, which is kind of in line with the global average. If you look at all the other market has performed during the same period. For example, I have a printout here. US dollar emerging market, down 16. Even US investment grade, both sovereign and credit together, were down 12. And Treasury, US Treasury, the solid credit, we were talking about also down 11%. So on a relative basis, even though your sovereign bond is down 11%, given all the noise, all the headwind, all the things happening in the world and in this region, our fund has managed to be down 16%. I think on a relative basis, we are actually pretty good, especially if you compare to a China only and also other Chinese market. And I think our fund performance year to date has performed quite competitively versus the universe, as also versus some of our peers. Annualized return around 6%, annualized volatility since inception a little over 6.5%, which is okay. Not great, but okay. It used to be this number is greater than 1. However, the cash yield at 8.6%, which is more than sufficient to service the 6% payout, and year to maturity yield to put 26%. This fund has always been very short in duration. Right now it's a little bit over 2 years. One thing I want investors to know, when they buy this fund, okay, they are not buying a bond fund that is very sensitive to interest rate move. As Jonathan has mentioned at the beginning of this session, we are a credit specialist. We buy corporate credits. And therefore, we believe that our fund, which has historically been showing, has not been very sensitive to interest rate move. That said, however, this fund will be very sensitive to credit event. So I would say the 2 year of duration is more representative of the credit duration more than interest rate duration. Okay, so there's one thing that really investors really need to pay attention. We hold a reasonable diversified position portfolio, about 100 bonds, usually between 100 and 120 bonds, with more than 50 different issuers. Here is a snapshot of how the fund looks like at the end of August. So as you can see, we are about 55% in China, Hong Kong. Used to be much higher, as more than 70%. In terms of property, 19-20%. In fact, the 19% property, we have around China property only around 15. So we have around 4-5% in Indonesian property. So other than property, we have allocate for the last 9 to 12 months, we have pared down our China property exposure, and we allocate this money into sector that will benefit from, number one, the commodity rally, and also energy. So utility, materials, and energy are 3 sectors that has benefit from the rallying commodity prices. Okay. The 7% transportation is there because we want to bet on China reopening. For example, we have a company issuer there in terms of the car rental company, and also some transportation related logistic company as well. The cash level is relatively high at 14%. I think this is an expression of we being, first of all, cautious. And number 2, we want to save the dry powder ready to fire when we can identify accurately a real pickup will come. So therefore, we want to have some dry powder ready. However, the entire credit rating of the fund, as you can work it out, is around BB, which is the highest rating of the high yield sector. Here is the historic distribution. As Jonathan mentioned, 1.5% for every 3 months, total 6% for a year. In some year, if we have done our hedging well, we have also a terminal distribution every June. So for example, in 2021, we distribute more than the 1.5%, and also in 2020 as well. We have a substantial gain our currency hedge, and we end up distributing around 6% at the end of June that year. So that's the end of my presentation. So we can go to the Q&A.
You, Gordon. It's just mentioning to Paul, if we actually sat in that corner, it looks like we're in detention. So that concludes the formal content. And thank you everyone who's been sending in questions. The questions are really, really good as I'm going through them. So I think Renee and Gordon will join us back up on screen as well. The guys, I think they're just working that out. Excellent, thank you. So keep asking the questions on Slido as I'm looking through them now. I'll directly address one of the questions myself first. They're asking about how the pension system will work. So to give a bit of background, what the government announced in April was called Pillar 3. Pillar 1 and 2 were very different structures. Pillar 1 was effectively a government pension. So think of it like government employees, defined benefits, what we know is that in Australia. Then there was Pillar 2, which is called corporate supplementary. So it meant that large corporates were invited by the government to set up pension plans on behalf of their employees. This third pillar is effectively allowing employees to contribute on a discretionary basis 12,001, or that's worth about 2,500 Australian dollars a year, into their super, and that will give them some tax breaks. In terms of what that level of tax break is at the moment, that hasn't been spoken about yet, hasn't been fully launched, but that's the details that we have at hand. So that answers that question. So obviously the first one, and someone's asked pretty directly, over to Renee and Gordon, how likely is the potential hot war between China and the US, and how should investors approach this potential?
I can start.
You start.
Okay. No, thank you for the questions. Yeah, I think I have seen those questions on the list. It's really good questions. I agree with Jonathan. I think for this China and US situation is for here to stay. One big question mark would be who will be the next US president. You know, without knowing that, you know, it's very hard to forecast or maybe speculate even more accurate. But I think the trend has started. The two biggest, you know, maybe allies or maybe whatever you call it, like using China as the major factory for the world has ended. So I believe that both of them have their own considerations, especially in technology, etc. So I think this sort of tension will come. Will not go away and will come into the spotlights now and then. So for investors, I think I would recommend that they should identify segments or companies that can still be less influenced. For example, some of them would be related to consumption, or maybe some of the selected segments in the technologies. So those are the trends, or maybe those are the tactics that we are trying to use to handle this challenge.
Gordon, did you have anything to add?
Yeah, I think this question actually is more related to Renee because, you know, as she mentioned, right, when US fights China, they're not gonna fight property, right? They're gonna fight chips, right, and also some of all the technology products. So in the credit market, we do not have many technology issuers in this space. So therefore, I think this question is more related to stock than credit. But I do agree with Renee that you know, this war has basically formed, right? Whether you like it or not, you know, when one sort of upcoming empire is trying to rule the world, and the existing empire will try to fight back. There will be a lot of conflict between these two nations. And to me, I think most importantly, to me, when people try to, you know, hold on their resources as not sharing, and also, you know, barring, you know, one another from getting hold of important strategic asset, these are highly inflationary in my view. So therefore, we believe that the world will stay, inflation level will stay high, although it will moderate. But I don't think price level will come down, and that's one thing that may be indirectly impacting bond investing. not just Asia, but throughout the world as well.
Sort of as an extension to that as well, remember that what I mentioned earlier about the world going from a globalized state to becoming very insular and being very protectionist. One of the outcomes of that as well is that there is no country or no major corporation around the world that doesn't want access to the Chinese market. So what we've also been observing in the last couple of years as trade wars have obviously ignited certain tensions is that those companies are trying to get their entire supply chain domestically inside China. So it doesn't get impacted so much by US legislation, or it doesn't get impacted by supply chains as much. Because if you can complete your entire supply chain inside of mainland China and then sell it to the local consumer, which is the thing that is going to pick up once the economy reopens, that is the critical point. Okay, how do you tap into that supply chain to ensure you minimize the level of disruption that is to come? Because this disruption, whether you use SWIFT currency systems, reserve currency status, all of that is going to impact different groups at certain levels. But everyone still wants a piece of China. Not a single company I've met that doesn't want to be in China, and they don't want to be hamstrung by that.
I think it's coming on. I think if you factor in the expectation that there'll be another 150 million Chinese out of poverty by the end of 2023 was the target, which means a massive rise in retail spending. Across the already enormous level of spending, the market in China in the middle class is just enormous in its own right. There's no Chinese company that needs to go outside of China to find one of the world's largest markets. So that completing that supply chain internally is something that is durable because of the size of that retail sector.
Yep. The next question is another really great one. So as we've seen in the last 2 years, China has moved to this common prosperity model. Okay, so they've taken effectively a viewpoint that what we've seen in most Western capitalist markets like America, Europe, and even Australia is that you've created a larger wealth gap. Okay, and COVID probably proved that more so than anything else. So all of us, very lucky in the room, we're white collar workers, we were paid all these stimulus checks, and now we're all cashed up, okay, with nowhere to spend. But then the people that were living hand to mouth, they're cleaners, they're bus drivers, so on and so forth, those people all missed out. Okay, so China's taken that common prosperity model, and the question then comes up is, given the fact China is going down this model, they're trying to equalize incomes, does that actually come at the expense of people investing in the market? Renee, Gordon?
So I think it's for me to start first, and then maybe Gordon to add. I think I see it actually. First of all, the financial market is still a very small segment. There are also another aspect of it on how the government wants to, like I mentioned in one of the slides, to change the structure or maybe promote the structure of the household asset allocation. So of course, I think there will be people trying very hard to move from lower tier cities to maybe to improve their life being. However, I believe that there are still a lot of people with liquidity, with a strong balance sheet that they want to look how to invest. So I suppose it's not as direct or straightforward in this sense.
Gordon, sort of from, I guess, a property lens? Because it's sort of the next question also links back to you, and it links to this previous question. So, if wealth distribution is the aim of the government and the way that they've obviously treated private property developers in recent times, is there actually a space for private property developers in China's new world?
Absolutely. I don't think that any country will be able to service the entire property sector just using state-owned companies. So obviously, POE developer will have its own space. But I think that, as I mentioned, at the end of the day, we will likely see proportionally more developer with state background, which, arguably speaking, sometimes has their own sort of social responsibility to fill, right? I think one thing China's government has seen that as a person living in Hong Kong, we have really, really great feeling about the property market. right? People wants to own a home, wants to own an apartment. However, it's extremely expensive. Everybody knows property in Hong Kong, private properties in Hong Kong is extremely expensive. Many people spend their whole life just to service the mortgage, right? And so therefore, I think the Chinese government does not want to see this to happen to the population. Therefore, at the end of the day, there will be a mix of sort of state building, which is available at a much more affordable prices. And then, for the rich and wealthy people, let their money to buy private home, so those will be built by private home enterprise. So therefore, I truly believe that POE developer will have its own space at the end of the day.
Probably a question for Renee. The Taiwan drought has affected chip supply, and that in itself has gotten a lot of airtime in the media. Has this subsided, and how will the rest of the world and the US, I guess the US chip bill as well, affect Taiwan's market share longer term, in your opinion?
Sure. With regards to the drought, basically they used a lot of measures, and then they were able to overcome all the water requirement for all these foundry businesses in Taiwan. So now it's no longer a key concern. But moving to the US chip bill, definitely it is something that we need to monitor closely. But I think the final terms of the US chip bill is yet to be totally announced. But from what we understand in terms of the direction, basically we see that it would not be a total one-sided kind of situation outcome. What I mean is that, for example, some UN, Taiwan, or maybe non-China, they welcome even non-China to invest into US, for example, like TSMC. For the US plant, they are also able to benefit from some of the subsidies. And then at the same time, if you talk about the foundry business, the key leaders globally would be TSMC, Intel, Samsung. But we have seen that on the advanced node, Intel has been a little bit lagging behind, to say the least, behind TSMC. So I think really depends, because this is a very long-term bill and then subsidy program. So it depends if Intel can really have consistent and improved execution. Maybe they can utilize the subsidy from the Bill Act more and then compete against the Taiwanese player. But so far, recently, we just also heard that Intel has delayed one of their factory and then might be shrinking the investments. So we don't know. This is a very ongoing, long process that we need to monitor. But definitely, we believe that it would not be a one-sided, meaning that all the US company would, at the end of the day, get all the market share because of this chip bill. So that is what we think now. Yeah, I hope this helps. Yeah.
The next question is obviously another very pointed question. What's happening with China's zero COVID policy? That's obviously a very big point of topic. And the interesting thing, I guess, to note is, for those of you that follow bond issuance in China, every year the government has something called a quota, where they allow local governments to issue bonds into the open market. What's been interesting in 2022 is that in the first half of the year, they basically used all the quota, right? So which means they've raised a lot of money. Now, in Chinese terms, what that actually means in reality is that bond issuance at the local government level equals infrastructure spend. China right now, as at August, has 7,600 infrastructure projects that is currently approved and hasn't started a single bit of build, right? So they're all in the pipeline. Now, this next thing I'm going to say is a rumor only. A lot of those infrastructure products apparently are slated, and I'll ask this question to Renee and Gordon as well, is to build hospitals. Now you think, why on earth are they wanting to build hospitals potentially at mass rate? Well, for those of you that remember early on in the pandemic, China rapidly built a hospital in 2 weeks. Why? To deal with the caseloads. So if China is building a lot of hospitals at the moment, there's only one reason why they'd be doing that, is in preparation for potential reopening and deal with the huge spike in cases. Over to Renee and Gordon, what's your viewpoint on China's COVID zero policy, and are they going to reverse that?
I think from what we have seen, what we have heard, it's actually getting better compared to when the zero COVID policy first came out. In the sense that before the lockdown was basically you lock down the whole city, whole region, whole province, right? Right now they are talking about much more targeted area, only area that has confirmed cases. They may lock down a few streets, a few blocks, not talking about the entire country, province, or city. So from that sense, the scale of the lockdown has been much more precise, much more targeted, in a way that the impact of the overall economy has managed to be, on the, more or less minimal to destruction.
Okay. Gordon, here's a really tough question. Obviously, investors since August of last year are now down 26%. When will they get their money back? Well, I mean, that's a question. I don't hide from any of these questions because they are genuine questions. And Gordon, as you can see, is a very frank and open person. So Gordon, crystal ball, please.
Honest answer to you, I don't know, because if I know, I wouldn't be here. But I think that right now, okay, usually I would say, right, I've been doing bonds for decades. And usually, as people know, that bond price barely move. In a normal situation, normal environment, bonds are considered to be a boring instrument. Bond price do not move, and they seldomly move. And when bond price move, usually something big happens, such as Lehman Brothers, right? Such as some of the Euro-Greek crisis. Those time bond price move a lot, oftentimes much more than equity as well. So we are in a market that is, sort of comparable to Lehman or even the Greek crisis. We were talking about, as I mentioned, right now in this region, we are not only hit by global interest rate hike, we are not only hit by geopolitical risk, even not in this region, in Europe, that will still impact through higher prices through inflation. And internally within China, we also have the COVID zero policy. So everything, we are being hit at all fronts. So therefore, prices has been down, okay? However, I have always been tell my client that, okay, if you invest in bonds, sometimes it's very different than investing in stock, right? Sorry, Renee. Stock, if you pick your name wrong, your value can go to zero, okay? Bond, if you do not believe an issuer is a default candidate, you just have to wait, right? At the end of the day, when the bond comes to maturity and the situation becomes normal market, either the company will pay you using their own cash, or they will be able to refinance in the market or the loan market, okay? We are in a market where this is what I consider to be extremely abnormal, okay? So therefore, I think right now, I'm also very frustrated because of the poor performance here and also elsewhere. But I think just have to say, investor at this part of structure needs to be, give it a little more patient. It's good that our fund pays 6% a year and we are still paying, so you will have some money in your pocket. It's not like you're buying a stock, all of a sudden they stop paying dividend, then you have nothing, right? You have a bond, you have your stock price down, and you have no income at all. So I think I would just have to say that you have to trust your manager to pick the right name for you, and then over time you will see your money coming back. That's my honest answer.
Thank you, Gordon. Now, final question. Back to Renee. Something we haven't covered off today, and sort of something we covered off historically. Has the Chinese government regulators finished their reforms affecting the likes of Alibaba and I guess the broader tech sector?
Yeah, thanks for the question. Yeah, I think generally speaking that most of the key directions of all this policy are definitely announced. I think now what we are looking at is the fine tuning, small points here and there. But if you talk about, in particular, the internet, Alibaba, of course, they will still need to control the end financial or the financial or maybe the online, financial platforms, because it is still just the starting point of launching all this control. But there are other things, I would say is fairly stabilized. So that's why we are still holding on some of our key internet-related companies that were suffering a lot in last year. But then going forward, we believe they have a strategy to fulfill the requirements of the government. So generally speaking, I think we are in a more stabilized situation. And I think I need to point out that last year, when all these policy came out and surprised or caused a lot of confusion in the global market, the Chinese government learned, listened, and they know that they were doing a very bad job in communicating. So they are now doing a more systematic way and more transparent way. So we believe that the reforms are not to be scared of, but then it is on the direction and within our expectation going forward. Yeah, I hope this answers your question. Yeah.
Thank you, Renee. And over to Paul to finish up.
So if you could all please join me in thanking our speakers, Gordon and Renee, and of course Jonathan. Thank you both. Much appreciated for your time, and we look forward to hopefully seeing you face to face in March. We're very keen to make that happen. That brings us to the end of the formalities for today, but you will, of course, receive an email which will ask for your feedback. For those of you who want CPD points, you do need to complete that feedback form so we can actually get you those CPD points. For everybody here, we thank you very much for coming today. We thank you for your support, the investments that you entrust us to care for, and we hope you enjoyed today, enjoyed the lunch, and and even though the weather doesn't look the best, enjoy the rest of the day. Cheers.